Just say live when we're live. Hi everyone, my name is Shantae Dennis. I'm here, Master Wealth Builders LLC, First Financial Security. We're here to educate you today on Saturday. This specific segment is for those that are online and live. We do in-person events here at Tysons in McLean, Virginia. Today our subject or our topic matter is going to be...
I took the one that they are taking some from, and
Yeah.
the new one.
No doubt.
All right, I can't even. Thanks.
All right, so we're here at McLean. We're here to talk about what's most important. There's a lot of things going on in our world, and we want to tackle the subject matter, advanced strategies with leveraging and saving in your retirement, how to use them to leverage them for your life, to leverage it for your business, and be able to protect your assets from market losses. We also are big on creating a better future so we can all work together, so we can help each other's businesses, and we can be able to grow and to do things organically. You know, even if you can't make it here in person, just make sure you're keeping abreast, you're logging in or looking at, we're posting on a regular basis on our Master Wealth Builders group. We would like the business spotlight you, so if you have questions, you can always inbox us, and we would love to help you and support you in your business along with your personal and family finances. All right, so the big thing is that today I'm going to get into the details of how you use the tools. I know we've had meetings and classes before where we talk about the generalities of things, of how you can utilize these tools to better your future, but I'm actually going to give you scenarios today that is going to break down to you in detail how these vehicles that we utilize, and we are talking about off-market annuities or fixed index annuities that can help you change your life. So the big thing is how you can use these vehicles to give you the future that you want. We want to know what you ultimately want to achieve. What are your dreams or goals, and how do you want your life to impact others around you, family, friends, and community, and how do you want to be remembered by the legacy that you leave? So one of the main things, you know, is that when we're designing tools or designing these fixed index annuities to work for you, we're designing it and customizing it to what your needs are, what your goals are. So if your goal is to ultimately be a business owner, have the business work for you, transfer the business to your children, if the goal is to just travel around the world, do leisure activity or the things that make you happy in the long run, we want to make sure financially you set something in place to achieve this goal. Most of the time, if you're an employee, you're depending on what your employer tells you or dictates you what you have at the end of your 401k or 457 when you reach retirement age. But when you self-direct your, long-term savings that can be used while you're still working, while you're still earning, and while you're still growing your business, you have the freedom to say, hey, if I want to stop working at age 52, I can start working at age 52. If I want to live the quality of life I want to live, I can control what that end date is and how I want it to work for me. So advanced strategies with using fixed index annuities allow you to leverage your retirement, because now your retirement or your long-term savings is in a fixed asset that's not going to take losses in the market. So if you are in a stock, a bond, a mutual fund, anything that's tax coded, 457, your TSP if you were a government worker or you were in military, Air Force, so on and so forth, it's going up and down in the market. One of the biggest things we're experiencing right now is a high market volatility. And why the market is so volatile is because it doesn't know what to expect. There's a lot of things going on in our political climate, health climate, things going on around us that dictate how the market may operate or how the market may move. But sometimes things may be unpredictable. So we want to make sure we do have a layer of safety. Yes, we can still take risks. Yes, we can diversify our portfolio, but we want to make sure that we are ready, prepared, and educated to make decisions for whatever the next phase of life or what's going to happen in our economical society. What we want to help people do is by leveraging their fixed assets, we can redirect money that you already have to grow more efficiently, to be put to better use and more intentful for what it is your goal is. We want to help you complete multiple streams of income that are tax advantage. If you have money that are called what we call qualified plans, meaning your money's coming from a SEP IRA, traditional IRA, or retirement plan, we can show you how to roll that money over, and then when you withdraw it, make it more tax advantage. You still may have to pay some taxes because you have to pay taxes at some point, whether you're paying taxes deferred, taxes going in, or taxes going out. But in these type of vehicles, you don't pay taxes going in. Now, if you have money in an account where it's like a traditional savings, a CD, something, or a money market, excuse me, then you can move that money, and when you take the money out, you'll get unlimited pension income for the rest of your life, where you'll never have to pay taxes on. So if the taxes go up, then even if the tax rate was at 50, 60, or 70%, you'll never pay taxes on your income. And ultimately, what that allows you to do is produce passive income, cash flow assets, become your own bank, and it can create economic independence. So you won't be worried about what's going to happen legislatively in our country. You're not going to be concerned about tariffs. I'm not going to get too deep into that. But I just want to make sure that people understand, regardless if we're in a good economy, a recession economy, a depression economy, or an inflated economy, you can overcome that by being positioned and have things set for that. So I'm going to not focus too much on this, but we do teach financial education. Going forward, we're going to have more targeted classes, things we can present to you, whether it's online, webinars, coming to maybe a state near you. We might be in Maryland or DC, Pennsylvania. If you're in another state, you can request for us to come somewhere and teach this education to you. But the information is out there. And the goals are, we want to make sure you have access to it. So one of the things we focus on is just that, we know in our communities, there is a big wealth gap in America. We know the wealth gap disparities are faced with, especially in the Hispanic and African American Black communities. And we know that Asians and, other races dominate the wealth, or the majority of wealth that is accumulated here in America. So we want to help people of all races, no matter who you are, to make it an even economical playing field. And the way you do that is learning about other resources that can help you, that are just not for the 1% or the super rich, but you can operate like the 1% or the most wealthy people by doing little things to accumulate or make smarter decisions with your money. So one of the three things we know in life that's going to happen, we know eventually you're going to get sick, you're going to die one day, and then sometimes what happens is that you may have a illness and injury and also outlive your retirement funds. So what we're trying to do is, within these retirement vehicles, they offer other options and opportunities where we have what are called well-being riders, living benefit riders, that can also help you with, while you're retired, if you get sick and you don't have enough funds to cover things, we're able to help you with that as well. So in annuities, in case people are not aware, annuities have been around for hundreds of years. They're financial vehicles where the financial transition and the way our money evolves never changes. So during the 1930s and the Great Depression and during wartime, when the banks went under, annuity companies still survived and people were able to retain or obtain their money. So one thing about annuities that, there are different myths, and don't forget there's different type of annuities. Now, I know annuities have a stigma of, it can be kind of complicated, there's a lot of fees. You know what? I'm going to address that. That can be true. But that's without talking to an expert that may understand how annuities work. There are different types of annuities. there are variable annuities, there are annuities. What I'm going to talk to you today is called a fixed index annuity. And the difference between a fixed index annuity and a traditional annuities, they have a little bit more flexibility. They allow you to grow with the market without taking the losses or charging fees. The way it happens is that, when the market is going up, you are earning a crediting index in between where the company is paying a participation rate to be able to participate in, say, the S&P 500, a BlackRock trade line, or another tech trade line that's doing very well or has a good performance over a series of 20 to 30 years. So if you have any, say what happened in the last 3 to 4 months, if the market goes down and you have earnings in the S&P 500, most people that were on the market took a loss or lost all their gains since several months ago. But if you had your money in an indexing vehicle, when the market goes down, it locks up. And when the market goes up, you earn an indexing credit in between. And you can earn in multiple ways. There's something called cap strategies. And then you can earn in participation rates, meaning where the market could be, say, for example, at 37%. Just an example, you might only earn 20%. But when the market goes down, you don't take a loss. If you were in a cap strategy, you can earn up to whatever that rate is if the cap is at 12%. But if the market goes to 50%, you're only going to earn 12%. So it's very important to understand the differences of how you can strategize and earn credits towards the market in a fixed index annuity. Right now, the rates are between somewhere, depending on the way you create it and strategize, are between 4 and 8.25%. And I'm going to break that down a little bit more in a moment. But the rates are determined where you can earn either simple interest or compounded interest rate. And I'm going to inform you that technically earning in a compounded interest rate is way better than earning in simple interest, because even if the rate is higher in simple interest, if the money evolves over time, if you've heard of the rule of 72, you will want your money to double in about 10 years worth of time. And it's better earned to do that if you're earning in a compounded interest rate. And the good news is the money does earn tax deferred. So I consider fixed indexing annuity like the Swiss Army knife of earning. So it gives you multiple different things within one vehicle. So even though the fixed index annuity is for the long term, you're either going to use it to earn an accumulation, to have something that's earning and you'll never take a loss in it, or it could be earning an accumulation but has an income component that earns at the rate of inflation. And then there's another component where you could just be accruing and saving until the time where you want to get that distribution, which is like your retirement, your lifetime income for life. An annuity, but then you lose all to have the same monthly allotment or money come out on a yearly basis for the rest of your life, even if you live to age 110 or 114, if you're blessed to live that long. So another component of a fixed index annuity, especially some of the ones we do, we work with top rated companies such as American Equity. And American Equity has what is called a well-being rider that in the time where if you get sick, and within that rider, there are several illnesses or a number of illnesses that are covered that would say if you have this illness and you're meeting the criteria, we will double your benefit or double the income in those up to 4 years for whatever time frame or whatever situation you're going through. So if your income, retirement income, say is $50,000 a year or $100,000 a year, whatever it may be, in those years you're activating that well-being rider, you will get double your money. So if you're at $50,000, you'll have $100,000 a year. That'll help you pay for unexpected medical expenses, anything else you need to put money towards, or if you recover, you can invest that money or reinvest that money in something else. You also get a savings account. So technically you're still saving money, but if you needed to take a loan against it, even if you were under 59 and a half, meaning under the age where you're legally able to withdraw from your retirement without a penalty, you can borrow and take money against your policy and pay it back and be able to use it for whatever investment or any purpose that you need to use it for. And then the most important thing is is with the annuity, you get a death benefit associated. So if anything happens to you, whatever's left in the account, if there's money still left over, it could be passed on as generational wealth. So one of the things we do emphasize at Master Wealth Builders is to set up a trust and have the trust be the beneficiary of your investment vehicle. So that way, when you're passing on the money, it's not just going to somebody that may spend the money in a lifetime or within a generation, but you can dictate how that money is going to be used throughout generation after generation after generation. And then the other thing that people don't talk about in advanced strategy is that it can also become a fixed asset. So if you go to the bank to get a collateral loan, say you're a new business and you don't have any business credit, and you're saying, well, this is what I have. I have this amount of money in the bank, and I have this amount of money as my net worth in fixed assets. You can take that same annuity that's already growing, get a line of credit. If, for example, if your interest on the fixed annuity is 6.50%, and you're earning that money back and you're not touching it because it's locked as a collateral asset, you're actually making back the money of any interest that you spend in the loan that you may get from the bank. So it kind of like counteracts or zeroes out the interest that you would have technically been earning. So that is a strategy of how to use a fixed index annuity to work for you before your age of retirement. So that's why these vehicles are good, whether you're young, middle age, or already at retirement age. And I always say your money should be working for you. Now this chart right here is just an example. Just, sometimes, it's better to look at it in graphics, but there are two lines. There's a blue line and then there's an orange line. So the orange line represents people that have their money in 401ks, anything tax coded, maybe a SEP IRA, a traditional IRA, stocks, bonds, or whatever. So this was somebody that invested money before COVID. So if somebody was on the orange line, which you had it in a tax coded vehicle, the market went up a little bit, then it went down. As you can see, they took a little bit of a loss, then it went back up. In this scenario, they started around 200,000, went up to 262,000, and then when the COVID drop came, they lost nearly about almost $50,000 out of the account and went back to 210. The person that invested the same amount of money, they went up, and then when the market went down a little bit, just dipped, which the market goes up and down all the time, they held on to their money, they held on to their principal. Then when the market went back up, they did receive that additional money, the $268,000, but then when the whole fall came, they retained their money. They didn't earn anything. They may have earned zero in that year, but they kept all their money. So that's the power in indexing, is you're protecting your bottom line, protecting your principal, and you're still able to participate in the market and get growth. Now, I do have clients that still like to ride the market, and that's okay if you still want to take risks. But I will say, the closer you are to age 100, I call it the rule of 100. If you've never heard of it, when you're 20, 30, you might have an opportunity to have another 20 years to make back losses from the market. But when you get closer to that 40, 50, and 60 bracket, you don't have time to make back the losses because you still have to break even and then get back to where you were. And then once you get back to where you were, you have to earn more than when you were at before. That takes time. So I say, if you're, say, 60 years old, if you're using the rule of 100 and you plan on living a wonderful life to 100, then 60% of your money should be in a safe place, and only 40% should be in something that's risky. Now, for me personally, if I'm 60, I would probably at that point want to have all my money in a safe place. But I'm still about diversifying. It's okay to have other things. I know we have digital, we have different things on Bitcoin. There's gold out there, there's different types of investments. So I do encourage to diversify, but just always look at, weigh out what's in a safe place or weigh out what's in a risky place. So the goal is to enjoy the gains without the risk. Now, this is just showing you basically, we all know the different things that are out there, and I hope we all know what are some of the options in growth and retirement and long-term planning. Traditional planning, already went over, 401k, 403bs, anything that's 400 tax coded, even your government TSP, is money going up and down in the market. Now, say for example, if you were that federal worker or somebody's in transition or lost a job, if you're not receiving contributions or, getting those additional gains on your retirement, you may want to look into a way without getting penalized, how you maybe can move that money over to something that's better performing and to put it in a place of safety. A lot of things that I've been hearing in the last 2 weeks, people are talking about my retirement. I don't want to look at it. I know the market's been up and down, because nobody knows what's going to happen next in our market.
Kara's watching. Kara's on.
Okay, all right. So, as I'm saying, I'm going over what are some of the other vehicles that are traditional that people use on a regular basis. So we're going over saving strategies that can help people right now, especially in the time that we are now. So right now we are experiencing economic fragility. The market, nobody knows what the market is going to do next. So we're giving you tools of how to protect your money. That is the goal. So whether you have a little bit of money, you have a retirement, or you're growing, or you have assets like properties or anything like that, we want to make sure that you have your money in the right places, protected and growing, and to continue to get educated on the things that's going to better assist you. One of the things that is the vehicle that we're really pushing, and because we're professionals, and I've been in the business for a long time, that can definitely help safety-wise. Annuities have survived the Great Depression, wars from European wars from hundreds of years ago. So it's always going to be a safe vehicle. But in case people didn't know, annuities have evolved throughout the years. And most people don't know that there are annuities out there, but still give you the growth that you want in the market with crediting strategies. So the index annuity that we're talking about today, you can get anywhere between, actually the percentage is between 5 to 10% bonus just from the initial of moving other assets. We call that redirection of stuff that you already have in place. So whether it's money in a CD, a mutual fund, or any other type of, anything where it's just sitting somewhere, you can roll over that amount. So say you roll over $50,000 and it was sitting in a retirement account. If you got the 10% bonus, you're earning 5% right away on that money. If you had equity in a house and you say, I'm going to take up $200,000 to $300,000, I'm actually working on a equity strategy with a client right now, where if you roll over $300,000, that person is going to get $30,000 right away, plus whatever the going interest rate is in that year. So if the interest rate is 6.5% and they get a 10% bonus, then that person is earning 16.5% for the entire year on their money. So there's a lot of ways to still have healthy growth without having to not feel like you're having a fear of missing out. Well, the market just went up to 80 on a stock, but when the market goes 0 on that stock, you lose everything. So we just want to make sure that you can have some healthy growth as well.
So there's a question, what's the minimum amount?
The minimum amount that you can invest in this type of vehicle is only $5,000. So it doesn't even have to be a flat amount. It could be if you have an employer and you have a job, you can actually have the deductions just come straight out of your paycheck. It just has to add up to the minimum amount. So if you're getting paid twice a month, then you just want to make sure whatever that twice a month payment adds to the minimum, but you can set whatever it is that you want to start saving. With these savings accounts, it's not like 401ks. You can have more than one. You don't have to roll over one to the other. If say all 5,000 is all that you have, you can start with 5,000, and you can either continue to contribute, or you can just say, hey, I have 10,000 right now. Maybe in a year I'll have another lump sum, whether it came from a settlement, savings from a job, or money from another source, and I'll start another account. What I usually recommend is to diversify the accounts. There's different types of growth, and I'm going to show you that right now. So even though there is a fixed index annuity, there's different type of fixed index annuities within that where you get to choose from. So there's something called Asset Shield. What Asset Shield does is just grow in, make sure your money's growing compounded, where it's just one fixed place. It's just like having a savings account at the bank that you don't touch, and you let it grow for a period of time. Usually you can do between 5, 7, and 10 years. 10 years gives you the best performance and growth. The good thing I can say about Asset Shield is that if you have to take out money for an emergency, it does allow you to incrementally take out up to 10% after the second year, for every year after the second year, of whatever the mass amount, 10% off of the balance of whatever the growth of your money is. So another strategy could be, if you want to use that 10% and take that out, you can take that 10% and reinvest it in something else. The second growth strategy is called Estate Shield. What Estate Shield does, it grows it. Now, the only thing with Estate Shield, you have to let it grow for 10 years. It has to be something where you can put the money away and not want to touch it. So that's the savings account where you let it lock, let it grow. But after 10 years, or whenever you decide to utilize it, or you can always keep the account and let it continue to grow, it gives you an income stream. But when you get the income is increasing year to year, and it's meant to do that to rise with the rate of inflation. So maybe let's say you invested $60,000, and $60,000 doubled to $120,000, and you're making $18,000 a year off that money in an income stream. Well, instead of getting 18 every year like you would in a fixed retirement, it might be 20 the next year. It may be 22 the next year, because it's growing in compounded interest. And then with the Estate Shield, you're keeping your principal. Your principal is still growing with the income coming out of it. So that's why they have you lock it up and don't let you touch it, because the growth in the vehicle allows you to earn more. And
okay.
then
There's another question. He says, can you make payments if you don't have the full amount?
yes, as long as they're equal to the minimum, like I was saying earlier. So if it was $5,000 as the minimum that you could contribute, if it's coming directly out your paycheck, and let's say you're doing a $200 a month, yes, you can do that. So if it's $200 a month, or let's say 5,000 divided by 12, that would be more like closer to $300 or $400 a month that needs to be contributed.
So the answer is yes, as long as it equals the $5,000 minimum.
Yes, absolutely. So yes, you can choose the route to just contribute. You can contribute for all those years and keep contributing and contributing. So yes, you can. You can come up with an amount that's comfortable for you, as long as it adds up to that amount per year.
So the minimum is $5,000, and the monthly payments would be $5,000 divided by 12.
Correct.
Or if you wanted to contribute
Or you
more.
could do that in the first year, and then we'll have to see if, because it has to be a minimum of $5,000 for the base balance.
He said, okay, thanks.
Yeah, absolutely. And keep asking questions. This is supposed to be interactive. It's just for you online, so I want you to get as much detail and information as possible. And it does have on the screen what I just said. You can access 10% penalty-free withdrawal per year, up until the maturity date of the vehicle. All right. Oh, so before I do that, I'm actually guys going to show you an example of what one looks like. All right. So if you can see the screen, I know it might be kind of small for you guys online. This is an example of what the Estate Shield vehicle looks like in growth. So with the Estate Shield, what I've done with this particular example, remember I said you can customize and develop your plan? I'm sorry guys, we are busy today. You can customize and you can develop your plan. This is, if you look at the left-hand column, it gives the amount of years you're invested. It shows the age in which you invested.
They can't see those numbers.
Oh, they can't see the numbers? Okay. Let me see if I can make it a little bit bigger. All right, so let me start here. All right. If you guys can see a little bit more, but this is just to give you an idea of what it actually looks like. So this is just a Estate Shield. This is something that doesn't have a bonus, but the thing is that it does earn and compound interest very well. So this is an example of somebody I literally just did yesterday. They're going to invest $300,000. They split it between 4 different trade lines. So we're going to use BlackRock, S&P 500, and you get to be a part of the conversation. Like, you don't have, it's not like having it managed by Vanguard or Fidelity. You can say, you know what, this is the strategy I'm going to choose for the first year. So I will say you do get an opportunity every year on your anniversary to adjust your crediting strategy. So there's called a point-to-point, meaning like we're just going to point to pin whatever the what it's doing with the participation rate for 1 year. And then the reason we're doing 1 year and 2 year strategies, what it means is that the interest pays out at the end of every year. So say this BlackRock does very well and it earns on average 8 or 9%. Then you're going to get paid out 9% for that entire year, whatever the average earning was of that particular trade line. Now, there's something called a 2 year participation rate, point to point. And the difference between a 2 year, the participation rate might be higher. So that means they're going to give you more credits towards whatever that same trade line earned. So some people rather see interest in the first year, so you can have a half strategy where you get to see some of the interest, which I know right now is at 100%. And then if you do a 2 year, the participation gives you 125% of whatever that participation rate is doing on the credit. So, these are little details just to show you how you can still play with it on the market and get different types of growth outcomes. But the goal of a fixed index annuity is no matter what, you're going to grow because it's still fixed and you still have part of that fixed rate strategy in it. All right, so I'm just scrolling over so you can just see a little bit on the end results. So after the 4 trade lines, it just shows in total values what the accumulation value is from year to year. So on the second year, in this particular scenario, it's just giving a scenario that say it's estimating that maybe there'll be no interest earned. It could be 0 for the year. And the reason I'm saying that's say if there was a market crash this year. And that doesn't mean that this is the way it has to perform. It may not be a market crash in year 1. But what this scenario is given, it's just giving an example to say if the market crashes, then you still have your $300,000. But if the market goes back up in year number 2, then you have earned an estimate of $18,000. These projections are usually fairly accurate because it's usually using the last 20 years of history with how these trade lines have performed over time. So it calculates risk in regards to whether we have recession, like when we had a situation like COVID. It takes all the risk and it gives you an estimate of what you should be seeing modestly how the market performs. So it looks like by year number 5, you do earn about $72,000 in this vehicle. I'm going to show you year number 10 because year number 10 is where you see it usually getting to the point of where your money doubles if you never touch it. Okay, so now I scroll down to show you what a fully mature 10-year maturity looks like in this vehicle. Now, the thing is, this particular vehicle, if you keep it and never touch it, it can go to year number 100. But it's up to you. Year number 10 gives you the opportunity to reevaluate if you want to move the money, see if it's performing well. But if it keeps performing, you can keep it. Now, if you're younger, you might not need the money from it maybe for another 10 or 15 years. So it will continue to grow. So I'm going to show you what year number 10 looks like. So we got year number 1, year number 2, 3, 4, 5, 6, 7, 8, 9, 10. So in year number 10 of the vehicle, you would have earned $180,000 even if the market doesn't perform well. So you're almost at the doubling point. And that means that whole 200 or the money that you put in is now getting to the point of doubling. Now in this chart, I added the year of retirement. So I put it, this was for a 50-year-old individual. So this would be if they're age 65, the amount of money they would have saved if they never touched it. So out of the $300,000 they start with, the amount that they have to withdraw from at this point is $637,000. Now, off of that money, they would be able to take a pension or the yearly distribution. This is the income stream for life that's tax free that they'll never have to pay money for. So because they never touched it, they never took money out. If they keep it all the way through, and this is just only if the market doesn't perform better than what is shown in this illustration, they're going to at least be able to pull out $71,000, $71,039 to be exact, for the rest of their lives. And if you look in the 4th year of their distribution, I just did an example for them. If they got sick by the age of 70, so say they got cancer, had a heart attack, stroke, or they're overcoming a major illness. I'm sorry. This is the accumulation. Let me take that back. So with this one, the money is going up with the rate of inflation. So they started out at a 71,000 distribution. It looks like in year number 3, it goes up to 74. And by the 5th year of the distribution, they're almost getting $83,000 to $91,000 a year. So it keeps going up, up, and up. So as long as they're lived, they're going to get a stream of income that will continue to go up with the rate of inflation. But the reason this particular vehicle was allowed to do that is because they weren't allowed to touch the money for 10 years. So they were able to pay for them to be able to receive this type of income for the rest of their lives. And even if you notice in the next column, the money that they had saved up from the 637 is going down. So eventually that money is going to run out, because if you're paying somebody $70,000 or close to $100,000 a year, you're not going to have that $637,000 anymore. So what would happen in a traditional retirement plan, like a 401k or a 403b or 457, you would just run out of money. So if you live to 90 or if you live to 100, most people are just living off of Social Security. And that is one of the major problems in this country, that if you're even blessed to have a 401k or a retirement plan, unfortunately, if you only have this amount of money in there, it's not really going to last you long.
So the question is, when the money, as it goes down, so from 630 to 577, when it gets to zero, how much money?
The money continues to pay. It doesn't stop. It keeps going up. It keeps getting paid out, and it gets paid at the rate of inflation. So it becomes a pension.
So even though the cash value went to zero, and
correct. That's
what year is that? Year number?
Continues to pay.
So at 100 and okay, so that's because he's at 114. All
yeah,
right.
Correct.
So
absolutely,
that's why it ended it. But it doesn't end as long as
once it's locked in and you start getting the distributions, it's for life. It never ends. So it's just like if you think about the old school pension plans.
Well, up to 120.
Mm-hmm. And it'll pay out to, if you're blessed to live such a long, wonderful life, it will never end. You will continue to get that money. And the good thing about it is if you look at the other column, so let's say, go over a little bit. All right. So say something happens to you before the money runs out. If you notice, there's another column running on side of it. That's the death benefit column. So the money that's in the account is whatever's left in it is the death benefit. So if something happened to this person at age 70, their beneficiaries are still going to get $126,000. So that's pretty much how it works. And then when it's gone, it's gone. But that person continues to get that money for the rest of their lives. And if somebody is married, there's also a thing where they can do it jointly, and there could be survivor benefits. So that money can continue to pay to the spouse or the next designated person as well. And if you have any questions, I just wanted to make sure you had an idea and could see literally a real life scenario of somebody I'm working with to see how it works. Now this, of course, the numbers are different depending upon how much you're contributing, what you're putting in, and also it's also based upon if you don't take money out. Now if you take money out, then we have to calculate a plan for that. But as long as you're keeping the money growing, this is how you create your lifetime stream of income or get to those goals that we talked about in the beginning. So like I said, if your goal is like you say, hey, I need $100,000 a year to survive, I need $3,000 a month to be secure because my house is paid off, or I want to travel or live a lavish lifestyle, this is how you start to save for it. You can actually plan with these vehicles to say, hey, I have 3 of these vehicles. One's going to give me $20,000 a year. One's going to earn me $30,000 a year. And that's why I was saying you can stagger the savings. Like say right now, all I have is $10,000, all I have is $50,000, all I have is $100,000. Well, guess what? As you save over time, if something else, if you have another lump sum of money or you save money, you can start another one. So you can have 3 streams of income. It just doesn't have to be one.
So can you take a loan out instead of taking a withdrawal?
Yes, that's the best way to do it. So my advice, at whether you're 59 and a half or over, is if you're planning on keeping the vehicle and you're not taking it out or starting distributions, take a loan and pay it back towards yourself. So if you take a loan and you pay it back, then you're still earning interest on your money. So it's like you never lost anything. That's to become your own bank scenario.
But do you have to be 59 and a half to take out a loan?
Nope.
So if I put the minimum and I need the 5,000 back, instead of taking it back, I just take a loan.
Yes, but there are limitations. There are amounts based upon what year you're taking the loan in. So that's, realistically, you can't put in the 5,000 in year one and expect to get money out without any type of, penalties or surrenders associated with it. But we would be able to individually talk to you and work you through it to see what your plan is. So this particular customer scenario, she actually gave me a scenario that maybe by year number 8, she may move and she may need a portion of the money to put as a down payment on the house. So we actually talked it through what that would look like. But by year number 8, she would be able to take almost up to 80% out if she chose to use it for another purpose without penalties. So there are ways to do that. But at the end of the day, if you're doing it for the purposes of not accumulation, but to get income, you just want to make sure you understand how that can affect that pension plan. So the goal is, if this is an income vehicle, you want to be able to have as much money as possible coming to you when you're getting your annual distribution at retirement. But you can, still use it before then as well.
But that's what I'm saying. Instead of taking a withdrawal and dealing with the penalty, why don't you just do a loan?
Do a loan. That would be the best scenario, yes. But it's my job to inform you that you do have that capability. I know there's a lot of people out there that do take out withdrawals from their 401ks or 457s. So I just want to make them aware this can still operate the same way. But as an expert, it's best not to do it that way and be more creative and take it out as a loan. And I'm just going to show you an example of, when you're, as a customer, reviewing your plan or your customization, it'll break down to you, what you will get on a monthly, not just a yearly basis. So, let's see. Most of the time, people are most concerned about, their household expenses and income, and to make sure at the bottom line that no matter what happens or how this performs, that you can pay your bills. So when you're creating this vehicle, you can see what the worst case scenarios look like, what the more guaranteed or non-guaranteed based on performance. So say, your maybe by the time you retire, your mortgage might be paid off, but you pay bills, you pay HOA, you pay real estate taxes. I have a client I talked to the other day, his expenses are $2,000 a month in retirement. So you want to make sure whatever you save, if it never performs in the worst case scenario, that I can afford to live off of whatever the monthly rates are or whatever the monthly distributions are. So a best case scenario with this is that the client gets $59, almost $6,000 a month in their retirement off of this one vehicle. Or the worst case scenario is that they only get $1,700 if worst comes to worst. Like say they only earn the fixed rate, nothing happens, nothing performs. Which the average person in retirement only gets close to $2,000 between Social Security and their retirement payments. So we want to make sure we're aggressively investing in the right places, we're managing properly, so we can get at least halfway in between, close or outperform what we expect to get in the long term. Now, in the 401k, you can't do this because nothing's guaranteed because it's going up and down. And we know the average statistic of 401ks down. Most people are only retiring with only close to 200 to 250,000 outside of Social Security or any other type of pensions. All right, so we show you the worst and we show you the best case scenario. So that would be for you to decide, well, how many investments I need to have to guarantee my best performance. But the bottom line is you're never going to lose your bottom line principal. All right, so the next vehicle I want to make sure I give you the option of today is called the KiaZen plan. It's the 5-year retirement plan. Now, this is another vehicle, and the reason I'm showing you this, some people, like the client I talked to yesterday, can afford to do both. So you can do it in combination strategy. With the 5-year retirement plan, there are some minimum factors that you have to be able to meet. Now, we know everybody may not qualify because the household has to be earning at least a minimum of $100,000. And the reason for that is because the 5-year retirement plan is aggressive. So you may be saving, let's say if you make $100,000 income in a household, the goal is to be able to save a third of what you make or a fourth of what you make. And if you do it in 5 years, then you don't have to spread it out over 20 to 30 years. Your retirement could be paid up for 5 years. But the beauty in this particular plan, if you are able to do this aggressive investment, the lender and the bank is contributing, just like your employer might match you. They're going to contribute $3 to every $1 you invest. And you, as the contributor, only have to contribute for 5 years, while they contribute for a total of 10 years on your behalf. So it becomes a bank loan. So if let's say that $200,000, I told you that people only maybe retire on average, well, more than likely at the end of a KiaZen plan, it's a 10-year plan, they will have 3 times the amount because now they're earning with the interest of the bank loans money for the $3 for every $1. And then at the end of it, whatever you end up with is the total of your principal balance plus the interest earned on your money and their money together. The good thing about this, it does have some benefits. It's a tax-free death benefit. Tax-free living benefits. So remember I told you in the last vehicle you get a well-being rider, meaning the income will double if you get sick. On this one, you can pull out the death benefit. It's a hybrid of an insurance policy and a retirement fund. So you would be able to, if you got terminally ill, pull out a lump sum out your, usually with these vehicles, the death benefit are very high, so it could be $500,000, it could be $1 million, and if you had $1 million death benefit, you could pull out 70% or 80% of it if you're terminally ill. If you're chronically ill, you might only be able to get up to 60% of your money out the death benefit, but you can use it any way you see fit. And then if you're just like suffering from a disability, you would get a disability check on a monthly basis that will help you towards whatever medical situation you're happening. And the reason I really want to talk about the medical part, you see what's going on in our country right now. People are concerned as they age if Medicare is going to be around, if Social Security is going to be around. Those are 2 governmental organizations that help with disability and pay for your medical expenses. So imagine if you're able to self-direct your own money to create your own disability line, you could pull from this and you could double your income with the well-being rider. They're 2 different vehicles. So you'll have 2 different ways to have extra money to cover you in a medical illness. One of the biggest things that bankrupt people in this country is a medical illness. We even know with major medical, sometimes certain things aren't covered. If people have cancer, they have to go through chemo. If they want to get an experimental drug or opportunity, they have to pay out of the pocket. So these vehicles help and cover you with that.
So you're saying that this can be used as a alternative or a backup to Medicaid, a backup to disability insurance, a backup to, you losing your job.
Absolutely. This is self-directed disability options through retirement and insurance. Absolutely. So it's income that could be used to whatever expenses you want to use it to. In another segment, we'll talk about some alternatives to self-direct, outside of traditional, major health benefits. But yes, this is disability pay through insurance and disability pay through an annuity. Absolutely, yes.
So if you have an IUL or if you have an annuity and then you have a qualifying medical event, basically you can get a payment and it has nothing to do with your job.
Absolutely. Correct. Which is actually better because your job limits you on how much you can receive. I actually personally can tell you from using my work disability at one point, they only can pay sometimes only up to 60% of your wages. So it still may not be enough money to cover the major medical costs of a major medical event. So I even tell people, even if you're still working and you have your group coverage, it may not cover everything that you need to have covered. So this is still good to have in addition.
So your work is only going to pay you 60% of your paycheck if you get disability?
Yeah, it works in intervals. Sometimes they'll give you for the first few weeks, they may give you, depends on the type of disability setup. All of them are different, but majority of them work the same. Maybe for the first 3 weeks, they may give you your full paycheck. And then as you go through a medical situation, if it lasts for a long time, they reduce it incrementally and it can go down to 60%. And then after the 6-month period, when you're on disability with a job, they may encourage you, and most times encourage you to go to full disability where they're not paying at all anymore anyway.
So basically you have a disability option from your
your retirement and your insurance.
And from your IUL.
Absolutely, correct. And glad you mentioned that, TK, when you say the word IUL. Even though this is a KiaZen plan, KiaZen is based from a company at NIW, and I will share with you those links so you can research it for yourself. KiaZen has been around for over 20 years now. It just wasn't open for just everybody in the general public before because you had to meet certain criteria. So now they've given more access for people to have KiaZen. KiaZen actually is a hybrid with a life insurance policy with a company called National Life Group, which National Life Group supplies what is called the Summit Index Universal Life Insurance Policy. So with this retirement plan, even though they're contributing for you to get lifetime income, you also get the Summit Universal Life Index of the Universal Life Insurance Plan. So you have an insurance policy within your retirement vehicle. That's why it's a hybrid and what makes it so special. So if you have enough money to diversify between the annuities that I showed you earlier and also participating in this, and actually you don't even just have to diversify. If you just want to do this program, you can do just this program, but I'm just trying to give you all of your best options. But the good thing with this program, it gives you both. The only difference between the annuity and the KiaZen plan is just more qualifying factors. You have to be qualified and I can't go over it right now. We'll work with you on an individual basis to determine if you will qualify or not. There's health factors into where they qualify you because they give you more money and they're investing more in you than you just investing your own money. And an annuity is just straight moving from one savings account to another savings account. So an annuity is just like an IRA. It operates like an IRA. And you're just moving money to save money in a more creative fashion, in the indexing fashion.
So basically, you can have multiple vehicles.
Yes,
you can have a KiaZen, you can have an American Equity, you can have 2 American Equities, you can have a combination of all these products.
Yes, absolutely. We know people that have several of these. You know, if you're doing well enough to be able to really accumulate wealth, you can go from vehicle to vehicle to vehicle to vehicle. So yeah, you can have 1 or you can have 10. There's really no limit. It's just the way you design your portfolio. It's just like having a portfolio. Just like when you go to the brokerage, they invest your money here, they may invest your money here, but you're paying, the difference is you're paying them a fee to manage and invest your money. This way, you're self-directing and you're doing it just for yourself. You're saying, I want to do this. You're saying, I want to. You have control over the way you're managing it. You're just talking to a professional that's licensed like us, where we can guide you through it. but you are making the decisions. We're not making them for you.
So do the annuity have fees?
The annuities we're showing you today do not have fees. That's why I said in the very beginning, yes, there are annuities out there, and we have access to them as well too here, but we just try to provide the best possible option that'll better help our customers. So we try to review annuities with people that don't have fees first to make sure that's the best fit for them. Because sometimes people want to pay the fee because maybe they want to buy, it's just like when you get a mortgage and you want to buy down the rate. Maybe some people like to pay fees on certain type of annuities to get just a better rate or a guaranteed rate. But we do already have annuities performing well that have no fees. Now, with the annuity specifically, when you add on the well-being rider, it's the only difference is that the rate is slightly lower because the percentage of the lower rate is paid towards you having that well-being rider. Now, you're not really paying out of your account, but you're just buying down the percentage rate to pay for that particular feature. That's the only thing that has a fee feature, but it's not a fee that's coming out of your principal balance. They're just, instead of giving you 8.25%, they're giving you 6.50% to allow you to have that lifetime income rider and to have that well-being rider. Now, you can choose to have no riders at all and just grow your money, and there's no fee for that. But if you choose to have the rider to have that guaranteed income I just showed you, you're just choosing to have a percentage less. But like I said, it still benefits you because it's compounded interest, and you'll still earn more than what technically the 8.25% simple interest rate would have got you. So I will say, yes, that's the only way they, on these particular ones that I'm showing you, where there would be a fee, but it's not really a fee. You're just paying a lower percentage rate down to pay for the additional feature. That's it. All right, any more questions? Oh, in the other part of KiaZen, if anybody online is an employer, it does allow the employer to do contributions on behalf of the employee. So you can put these in your businesses, and it gives you a tax advantage, with the Secure 2.0 Act that came out, where you're able to get tax credits for contributing on behalf of your employees. So employers can actually choose KiaZen over having a traditional 401k plan for their employees that actually may work more efficiently. And it gives the employees to have more control over their retirement accounts. So that is an option as well. We're going to do another class for that because we do want to help. We actually just started helping a couple of employers that have employees as of yesterday as well too. So there are a lot of ways to take advantage of KiaZen and even the annuities as an employer and offering it as an incentive to your employee as well. So with that being said, with the employees, we do know that companies have problems recruiting, finding new talent, and, choosing hiring platforms. So the reason we do present the annuities and the KiaZen plan to them, it does help with being able to offer a good benefits package that's better than traditional retirement plans to their employees. But like I said, we'll do that in another segment. All right, thank you for bearing with me, guys. Just got a little dry throat. But if you have any questions, please submit your questions online. TK is reading them to me as you're asking. So today I just wanted to keep it simple because I know there's a lot going on in our retirement. There's a lot of things that I will talk to you about later. We will do a class on the Secure 2.0 Act. We will just do a focus group just on regards to what I was just talking about in regards to the KiaZen plan. But I just wanted to show you how these things can work for you. And if you have any questions, the best way to get the best answers for you, yourself, your family, or your business is to reach out to us so we can consult with you. Now, I do say this a lot, even though we're here, as the experts promoting to you, but the deal is we want you to get the information because you need it. I mean, if you have a trusted source, I'm going to tell you right now, a financial advisor is not going to tell you about off-market solutions. I used to be one. So I'm letting you know that, they are not even, using these tools and techniques to help people, protect their principal off market. So you can still keep your financial advisor, but we're here to help you with the security piece. And we want to be able to help you grow and move forward. So we have our office number is 571-587-8167. We do have a QR code. We'll put it on the website. If you're on our Master Wealth Builders page, I believe our contact information is in there. But if not, when I get off today, I'll put in the appointment link, and you can click in there. On this week specifically, we're being very aggressive and very intentful because things are moving right now within our economical and political environment, and we don't want people to get left behind. So you can just, we're taking appointments Monday, Tuesday, and Wednesday, and we're going straight down the line just to answer questions that you may have. Now, whether you choose to move forward with us or not, that'll be totally up to you, but we just want to at least give you options and show you some of the things that I may not be able to go into and tell you everything today. So check out, go to our Master Wealth Builders group chat. I'll put in the link for our appointment calendar. You can meet with any of our team staff. I'm sure most of you are familiar with myself. I'm Shantae Dennis. TK Pryor is the other senior advisor here. We are the owners of Master Wealth Builders. We work with other talented individuals. We have partners in other areas of finance. So if you need help in other areas, we help people with trust. We have attorneys, we have mortgage loan officers, real estate agents, whatever your needs are. We're able to at least be able to help you all around as a one-stop shop. But we want to focus on this subject matter this week because we don't want to see people like what happened the last 2 weeks continue to take losses in the market. So if you have any questions, give us a call. We're here to take care of you. And then if you are in the area, we have another event coming next week. We would love for you to be in person, have the experience, so you can meet other like-minded individuals that can maybe help you reach your goals and within our community and help you reach your level of success. Thank you very much. Have a wonderful rest of your day and be blessed.
Hey guys, I'm just going to close the meeting. I want to say thank you for showing up online. We do this every single month. So if you want to come to our Facebook group, you'll see the video in our Facebook group. I'm also going to get to the point where I put it on YouTube too. But understand that the idea here is to share some financial tools to help you get ahead. Oh, I'm going to share this link here too. She just put the link up on the screen. For a QR code if you want to do a one-on-one consultation. But honestly, I'm a licensed professional. The idea is to give you some financial tools to help you. We want to multiply your money and protect it. So in order to do that, you have to use these tools. As she mentioned, all of it is principal protected. All of it gives you the opportunity to advance further than the people who refuse to do these things, right? Stock market will continue to take market fluctuation. And guess what? We're trying to protect you from that. So take a look at this QR code. If you're interested in doing a one-on-one, this is all you have to do is scan this and it will pop up on my calendar or on Shantae's calendar. So this is for those people who are watching the video or see the replay and they want to do a one-on-one consultation with us. So I'll just leave that on the screen. And again, thank you guys for showing up. Please come back next month. We're trying to even increase it to the point where we do it once a week. So we do it in person, but we record it and put it online so that you can see the replay. But we want you to invite someone and get the word out, because no one is coming to the Black community to explain these type of principal protected accounts, guaranteed retirement, having a solution that actually gives you disability outside of your job. So if you lose your job, you still have disability coverage because you have one of these policies. You know what I mean? It's still protecting you. And then if you get a family trust and the trust owns the policy, now you're starting to do what the rich do. So we're here to help. Reach out to us if you want to learn more, and then please come to our next class. It'll be in this Facebook group, and it will also be in person here in Tysons Corner, right down the street from the Tysons Corner Mall.